Bloomberg Audio Studios. Podcasts, radio, news. This is the Bloomberg Surveillance Podcast. Catch us live weekdays at 7 a.m. Eastern on Apple CarPlay or Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Long ago and far away, I got on a plane and I was sitting up in the fancy seats, and Christine Lagarde got on the plane and sat down one row ahead of me. We said hello, and she dived into the newspapers as the French banks blew up. It was a day where basically European banking collapsed. We start strong with the humility and history of BNP Paribas of Paris. Their Viktor Hjort joins us this morning in derivative and bond strategies. Victor, we are so honored to have you here with the French banking tradition. What does your measurement of liquidity look like in the system? Is the plumbing working in our financial system this morning?
So far, I think it is. In the corporate credit world that I live in, one good measure of this is what people are prepared to pay for the spread between derivatives and corporate bonds. And typically, when you have liquidity shortage, people are forced to sell their bonds. That's not really been the story so far, Tom. We've had a material move wider in spreads over the last few weeks, but it's been mostly driven by hedges, derivatives. It's almost like the situation where, you introduce a lot of uncertainty, people reach for the hedges, but they don't feel so negative yet that they need to sell their bond portfolios. And that's kind of where we are right now.
The tension in New York this morning is percolating that we're not there yet. Folks, for me, it's 4 standard deviations. We're not there, but that we're nearing a point where the Fed has to do something. They did that in a medical crisis, the pandemic. At BNP Paribas, do you have discussions that we're at a point where any given central bank, including Jerome Powell, will have to step in to right the chaos?
Well, first of all, I don't think that we are actually anywhere close to the conditions where that is that's on the cards. Even primary corporate bond markets reopened, although it was modest in the US yesterday. So the markets are obviously not shut. Then to your point, what do we think about the central banks? You're probably more likely to see the ECB being proactive here than the Fed. The ECB has actually a much easier job here, given the lack of inflationary pressures.
Brilliant, brilliant. Paul, a headline out here. This is what's moved the market now to 1.7%. I forgot my glasses, so Paul, if I quote something wrong, let me know. It's like I'm blind on the golf course, like Damian Sassower. Here's the headline, and this has directly to do with Duke University merch. China raises tariffs on U.S. goods to 84%. So that Duke sweatshirt from Champion, the reverse weave sweatshirt, I guess goes up 84%.
I mean, it continues, Tom, this tit for tat on the tariff front. This is kind of what we signed up for here. So, Victor, in the credit markets, where are we in terms of assessing risk? What is the bond market, the credit market telling us about recession risk in the U.S. economy?
Well, spreads are substantially wider, but we're probably nowhere close to actually pricing in a recession. If you look at U.S. investment grade spreads on your Bloomberg index, we're around 120 basis points. That usually gets to 140, 150, even outside of recessions. If you're going to enter a recession, you're talking about 200 basis points. So the credit market is under pressure, but it's still nowhere close to discounting a proper recessionary environment. It's actually only over the last couple of days, for instance, that the markets began switching focus from pure tariff concerns, like autos, like you mentioned, pharmaceuticals earlier, and started to focus on the real cyclicals, including financials, for instance. And cyclicals have started to underperform only in the last couple of days.
Victor, if we're going to see vulnerability in the credit markets, where do you think we'll see it first? Will it be in the short-term paper side, or will it be in longer-term issuance? if we do see some pain, where would you see it first?
So the one thing that's different today compared to, let's say, 2022, which was the last time we had volatility and spread widening, is on the borrower side. So back then, high-yield companies had taken advantage of the easy funding conditions during the COVID stimulus and extended their bond maturity profiles. This time around, they have a little bit less leeway. The bond maturity walls are probably 3 times what they were back then. So my guess is that we stay here for another few months. It's going to be the leveraged finance space that starts to look vulnerable. That's not the story today, but it will get there if we stay here.
Don't be a stranger. Thank you so much. I'd like to do the interview in French, but that really wouldn't. Viktor Hjort, thank you so much with BNP Paribas Paris out of London this morning to get us started.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
She does a wonderful synthesis of the moment. Many people do, but nobody does it better than Constance Hunter. She's with the EIU, and of course with macro policy perspectives, an advisor there as well. What's the one chart for you, Constance Hunter, right now that speaks?
It's the chart of uncertainty. And that chart takes into account EIU.
What, uncertainty at JP Morgan? Who's uncertainty?
So it's Nick Bloom out of Stanford. And he uses EIU data to chart the word uncertainty in our reports. Plus, he looks at changes in the tax code that are coming up. Plus, he looks at the divergence of economic forecasts. And when you add all those 3 things together, we are almost at the COVID level of uncertainty. But what we know going back to the 80s is that this presages recessions. You know that that recession data was backdated, right? You look at you choose a recession ex post. We know that the GDP data ends up getting revised down usually if there ends up being a recession. And so when we look at this chart, we know that there are certain behaviors that companies and households engage in when there is this level of uncertainty. And one of them is they do not invest. Mm-hmm.
So are you forecasting a recession?
We are forecasting a recession.
All right, talk to us about that.
Yeah, well, so we were in the process of doing our forecast last night as we were sending you our notes. And so before the latest...
That's where you were. I drove by Central Park South and Constance was at Murray doing a recession forecast. Okay.
Yeah, I had to have a glass of seltzer, not a glass of wine. So, I think that the story is, and everybody's going to be in this boat, we're just going to have to keep revising down, right? So right now, as of last night, we were at down 0.1% for the year. I think it's going to end up being lower than that. You don't have this kind of dislocation and then just bounce back right away, right? And the thing that we were arguing is even if the tariffs get rolled back, which is what people were talking about a couple weeks ago, you still have that uncertainty level very, very high. Now, of course, it's gone even higher. And what I said at a dinner party this weekend, I was talking about how I had written a note to everybody on my team saying, listen, I've lived through a few crises. My first one was the tequila crisis back in the 90s.
At Murray last night.
and there's always something that ends up being worse than you could imagine, right? And so there's some opacity somewhere that we're not going to see, some connectivity somewhere. And someone asked me at a dinner party, so when you wrote this note, did you tell them, what do you think? Is this going to be the worst of your career? And I said, yeah, it very well could be, because it's completely self-inflicted.
Right. Constance Hunter with us. We're going to continue with her here. And good morning. We say good morning to all of you with futures negative 103. We're out 5 figures on the VIX, 57.23. I'm not going to mince words on ugly tape and real talk about, to be polite, financial dislocation out there. Constance, one of the great things you do, and you've done this for years, is synthesize this into what central banks will do. We had a gentleman from BNP Paribas say, actually, the ECB has more degrees of freedom here to work than a Trump-affected Jerome Powell. How constrained is the Fed right now to act within crisis because of the politics?
So it's not so much the politics itself, but the political policy of raising tariffs, which we know is going to have an immediate inflationary impulse. And of course, the question is, when does that get overwhelmed by the negative economic impulse that then reduces demand and pushes down prices. If we start to get market dislocation, if Treasury markets start not to clear, the Fed is going to step in, right? I mean, so we're in a different, as we wake up this morning, we are in a different realm than we were yesterday. Yesterday, I would have told you the Fed is going to be fashionably late because they don't want to repeat the problems of COVID, right? They're going to be a little bit late and they know they have enough firepower. But if we're getting into a situation where we have breakdowns in capital markets and markets not clearing, then they're going to have to step in sooner from at least a market intervention perspective.
Yeah, I mean, Jamie Dimon's on with Maria right now. Paul, there's the headline. Economists are right to say we're headed for a slowdown. Jamie Dimon didn't sleep last night. I mean, the major banks, Paul, are doing risk management now against all this contagion, including speculation about losses in hedge funds.
Inflation, what's your inflation call here? Are we taking that up?
Yes, so we're at 3.6% for the full year, but what we cautioned...
Where were you before?
We were at 2.5, but what we've cautioned clients is that doesn't mean there's not going to be a couple months in there where we see a prints above 5%, right? Our expectation is inflation spikes up and then it comes down. But again, this demand destruction is very significant, and the supply effect that you would expect to have a little bit of a lag, the lags are going away. China said they're not importing any more LNG. They're just not importing any more of it, right? So everything is happening in a much more compressed fashion.
So where do we go from here? What are the next steps that you're looking for just from an economic outlook perspective? Is it starting to see it in the data? Because I guess if you look at the UMISH sentiment data, we're already seeing it, but we haven't seen it in some of the hard data that the Fed likes.
Yeah, I mean, obviously they're going to be watching. I think the next big piece of data that will contain some information about this will be the April jobs data.
Okay.
And we would expect that to be softer. And then you've got to look under the hood, right? What's the diffusion index? How many firms are hiring? Maybe we get a positive print of 120 or something, but the diffusion index falls significantly, or hours worked falls significantly.
What's your model unemployment rate out? I would suggest maybe that's the thing that moves this administration off there. Are you modeling a 5-figure on unemployment?
We're modeling 4.7, but I think we are, as I sit here, we are remodeling everything. And I think 5 is absolutely not out of the question.
Constance Hunter, thank you so much. Greatly appreciate it with EIU this morning.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Greg Peters is at PGIM. It's very important to speak, I think, today on the management side of things, of running portfolios, but far more. He combines that with tours of duty at Salomon Smith Barney. This is ancient. Columbus had just left. Yep. Salomon Smith Barney and at the US Treasury, and of course, iconic work when I first heard of him at Morgan Stanley as well. Greg Peters, compare this moment to the other analogs out there. Is it a 1998 redux?
No, I think it's very different this time, Tom. You touched on it with the SOFR spread. I know that's kind of a in the weeds type of measure, but I think what you're seeing here, and you're seeing it in kind of the correlation in the price action, is risk premium being put into the entire U.S. rate curve. You look at the price action over the past few days. Stocks have, sold off, and, you haven't really seen the bond market react, or at least react, as a kind of a defense mechanism. So, the markets are very nervous on the bond side around debt and deficits, foreign buyers stepping away in a meaningful fashion. And there's a lot of technical unwind. So this is a very sloppy, ugly bond market right now.
Within it is the question of liquidity. You've got Tripp, you've got Peters, you've got Porcelli when he decides to show up for work. Within the holistic PGIM view, are we edging towards a liquidity freeze up where the Fed needs to step in?
I think at some point that is almost inevitable. And I don't want to be a doomsayer, but I do think it is inevitable. At the same time, things have actually been reasonably okay and orderly, but there's only so much capacity to absorb treasuries, and the dealer balance sheets just don't have enough of that capacity. So I think it's inevitable, but we're not there now. This is an incredibly important week, of course. We had the 3-year auction yesterday. We have 10s and 30s today. That's a lot of duration entering the system. And so we'll have more, informational content to see how that notional kind of gets absorbed into the system.
Greg, you mentioned kind of the weaker than expected auction yesterday. We have more duration today from the Treasury as an issue. How important, if we have another week showing today, what would that tell you?
Oh, well, it means that there's just somewhat of a buyer strike, right? And so our read on yesterday's auction is, not a lot really came from it from an informational content standpoint. I think today is the important day. Watch the tail, watch the bid to cover. It's important to note that, we can't have a failed auctions, right? The dealers must take it down, but that doesn't mean it can't trade, in a sloppy, ugly fashion. So that's a lot of duration hitting the market at a time when there is a massive selling of treasuries across the board. So it's going to be very, very interesting. And the volatility is really extreme. I think it's important just to kind of note that the 10-year has traversed like almost a 60 basis point range in just a few days. Yep. Talk about standard deviation moves, Tom. That's that's just eye-popping.
Paul, I've got since April 4, the 10-year, and nobody ever quotes price except Liz Goldenberg. See the scar here?
Sure.
That's a Manolo Blahnik heel. She got so angry at me, she threw the shoe at me. It bounced off the terminal and hit me in the face. The price of the 10 years down 3.47%. in 1, 2, 3 days. That annualizes out to a 92% per year loss.
Oh boy, that sounds like 2022
It's a little bit hyperbolic there, for
Exactly, Greg. Who's been selling here the last several days?
Well, there's been, a few factions. There's been lots of talk around foreign selling. We'll know that for sure, when the data are released. But that's, a clear conversation in the marketplace. But you're seeing a lot of kind of levered unwinds. There was a very popular basis trade that, has been talked about a lot, over the past couple of years. But, kind of entering this year, there was a belief that, SLR type of relief would, come on board, and there was a loading up on that type of investment, which is, long treasury, short futures, and the stop outs and the unwinds are, pretty substantial. So there's just kind of broad-based selling, I'd say. There's a raising of dollars and, exiting, the U.S. bond market. I think it's also important to note that, trading partners, if their trading volumes are going down to zero, the need to hold U.S. Treasuries just becomes a lot less. So, that's just a natural byproduct of, trying to reduce trade, right? And that's an unintended consequence that, I don't think the administration really kind of thought through.
Greg Peters, thank you so much. About 8 more questions, but we can't get there this morning. Mr. Peters, of course, with his work at Morgan Stanley and Salomon Brothers, he's with PGIM across the Hudson.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
This is fun. Folks, in the jargon, across the pond is from London to New York. Out on the left coast, across the pond, is San Francisco. And the answer is Ernie Tedeschi did. Chad Jones did this too. And I think in the case of Ernie, he went from Stanford to Berkeley.
Not bad.
Which is there's no international comparison to this outrage. Joining us now from Yale with the Budget Lab is Ernie Tedeschi, who did. What was it like going from Stanford to Berkeley? Ernie, what did people not talk to you for a year?
They did. They didn't talk to me for a year, and I didn't care because I knew what a real college town was like when I finally went to Berkeley.
Oh.
I have to say.
What is it like going down the hallway and seeing the plaque of like DeLong, Eichen Green, and the rest of the criminals out there? I mean, it must have been just eclectic as all get out.
I took Brad DeLong's seminar on economic history, and it was my favorite class, bar none. At Berkeley.
I've heard that.
He's a character.
Such an honor to do some panels with him over the years, and he's been a huge contribution to American economics. With Brad DeLong's study of history, where are we right now, Dr. Tedeschi?
Where we are right now, we're at a very uncertain point right now. With these retaliatory tariffs that we the increase in the China tariffs that we announced, and then the retaliation from China. So we're at a effective tariff rate now of everything announced in 2025 of 24 percentage points. We've added 24 percentage points to our effective tariff rate. So that brings us to the highest effective tariff rate since 1903, as of today. For the average family, that's $4,600 in cost. When you add in the extra 50% on China that we just announced. So that's another 2.8% on the PCE price level. So that's, like Sarah was talking about before, like on the one hand, the Fed is going to try to look through that. I mean, on the other hand, that's going to cause economic weakness that is going to, pressure the Fed one way or the other to move in some way, I think.
Ernie Tedeschi with us, and I didn't introduce him properly. The Budget Lab at Yale, and I will not mince words, it's what everybody looks at early in the morning. The work of Martha Gimbel, Ernie Tedeschi, and the crew up there has just been absolutely superb on traditional budget analysis, but much more. Paul Sweeney?
Ernie, is your working assumption that globalization, economic globalization, is dead?
It's dying a slow death, maybe less slow than I had thought 24 hours ago. Yeah, I think that the dynamics now are going to start out across the world, maybe anti-American, counter-American might be a better word for it, with this trade war and response to America. But look, you can even see the politics seep into places like Canada, places like Europe. I think that this is fueling broader populist anti-trade sentiment that we all know was already there and already on the rise. And I think that this just punctuates it.
And on the flip side, Ernie, President Trump and his administration believes that these trade wars will result in the recovery or the redevelopment of American manufacturing. How do you see that playing out?
I don't see it playing out. The place where I see a lot of focus is things like automobiles. The United States already had a symbiotic relationship in North America with automobiles, so it's really unclear how we make much gains in automobile manufacturing when it's going to be at the expense of our free trade partners. The other thing, and we find this consistently when we model tariffs, when we kind of look at the long run economic effects of these tariffs, is there's no doubt that if you focus tariffs on a specific industry like automobiles, you can shift production within the United States to that industry. And so you can look at just say autos and say, oh, we can make gains just in auto manufacturing. But it comes at the expense of the rest of the economy. The United States doesn't have limitless labor and capital in it, especially in an environment where we're talking about limiting immigration. And so what we also consistently find is that, putting aside any specific sector, the American economy is consistently smaller, regardless of what proposal we're analyzing, in the long run. As a result of what we've announced so far in 2025, the United States economy is 0.7% smaller in the long run in level votes, which, as an economist is significant.
We welcome all of you worldwide on your commutes this morning, including good morning to New Haven. With the Budget Lab at Yale, Ernie Tedeschi with us here to give us perspective. I want to get to the budget matters in a moment, but we have markets on the move. There's no question about that. With the VIX out 5 big figures, we're dashing near 60 57.38. SPX down 106 points, Dow down 800 points on futures. The yield space, Paul, out 12 basis points in the 10-year yield. I want to take a moment right now. Ernie, stay with us. Don't run away. The most important person at Bloomberg today is Liz Goldenberg.
Okay.
Liz Goldenberg ran all of our bond coverage, and once she threw one of her Manolo Blahnik shoes at me,
oh boy,
almost took an eye out. And Liz said, Tom, in crisis, yield doesn't matter. This is really important, folks, and Ernie knows this from his work on the left coast. It's real simple. Fancy people in bow ties talk about yield, the yield this, the yield that. At the end of the day, a fixed income item is a bond, a bill, a note. It's a price. And right now, the prices are declining. That is the tension of the morning that we're trying to encapsulate for you. Greg Peters with us in 12 minutes. Michael McKee on the Fed in a bit as well. Ernie Tedeschi, let us go to what the Yale Budget Lab is acclaimed for. The president wants the free lunch of his new globalization, we'll call it, with a tax cut. There's no one I've read who says this makes sense. What is the path the president's on? And what does that mean for our listeners and viewers this morning?
Well, ostensibly, he's using these tariffs to at least partially, and it's only going to be partially, pay for his tax cuts. So if you were going to score everything that they've announced this year, like as its own bill, CBO would probably find that it raises 2.8 trillion over 10 years if it were to stay in effect. That's roughly half the cost of permanently extending the 2017 tax cuts. So, they've gotten halfway. Now, maybe they're only going to extend the tax cuts for 5 years. Maybe they're going to use other baseline gimmicks to make up for the rest of that half. Maybe they're going to introduce other cuts like to Medicaid or food stamps to make up for the rest of it. But they haven't fully paid for it yet. So number one, that's one reason to expect that there are more tariffs coming, is because literally they need more revenue than they've already raised. The second thing to bear in mind is that, of course, tariffs are a regressive tax. They pinch lower income families more than upper income families. And the benefits of what they're talking about in the tax bill skew to, they help everyone, but they skew to upper income families. So this is kind of a raw deal for lower income families.
I got to let you go, Ernie, because you're driving the market lower. We just got to get them off here. I can't say enough, folks, about the Budget Lab at Yale University. Everyone, Republican, conservative, whatever, Democrat, they're all talking about the work of Martha Gimbel and Ernie Tedeschi and a wide body of academics really thinking about this moment we're in. Dr. Tedeschi, thank you so much for joining Bloomberg.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.
Right now, we're going to go to Amanda Agati. Ari Wald's set up on Oppenheimer as well. John Tucker will give you an important update here in a bit. Amanda Agati is with asset allocation at PNC. Hasn't slept in 3 days, and we welcome her this morning. Amanda, how have you changed your asset allocation?
It's great to be with you guys. Thanks for having me. We're not making grand or sweeping allocation changes in this environment. Tweaks at the margin are the approach in this environment. And we're really trying to lean into the corrections that we're seeing in both the equity and the fixed income markets to try and reposition portfolios. And we really haven't had an opportunity to do this in a while. So US over international is still very much the place to be. Larger over smaller, and quality on the equity side are areas that we're tweaking at the margin here.
Paul wants to jump on that. I can just see him. He's like, why do you stay all American given what we get from 1600 Pennsylvania Avenue?
Well, we're not all American. We're leaning mostly American. We have a home country bias for sure, but we do have international equity exposure, both developed and emerging. We just have less. We're underweight relative to our benchmark. So we're not betting against international markets here. But I think in the face of this really unprecedented tariff and trade war that we have underway here, the rally that international equity saw at the beginning of the year is fading fast, and for good reason. And so we want to have a little exposure, but we want to be really thoughtful about how much, given there's still so much we don't know about the path forward for tariffs.
Amanda, we have a VIX here north of 50 right now. What does that tell you?
It tells me don't be a hero. You can use that as a hashtag don't be a hero quote for the day. And that goes back to this idea that we can't make big, grand or sweeping calls in this environment. There's just too much volatility. And as I said earlier, and I think the earlier guest also mentioned, we're in a crisis of confidence. That's a reflection of the volatility that we're seeing. And so you have to sort of stay the course and sort of look past a lot of this noise. The VIX is going to settle down, but we're in a void here of data points and headlines that have real meat to them and frankly earnings season. And so until we can get a little bit more solid footing from some of these fundamentals, I think this is just the volatility we have to accept.
Go ahead, Paul. Please.
What do you expect from earnings here, Amanda?
Look at the green on the screen. I was distracted.
Exactly.
I'm getting my face burned here from the green on the screen. Crisis over.
Exactly. What do you expect from earnings this season, Amanda? I mean, I'd be shocked if many companies are able to give pretty decent guidance or any guidance, I guess.
Yeah, I think that's going to be the key question. Of course, Delta this morning, first out of the gate, pulls the plug on guidance. So is that the ripple effect for what all of Q1 earnings season ultimately looks like? I think it's tricky because I bet you the underlying fundamentals, aka the results for Q1 earnings season, actually come in better than expected. We had the worst revisionary period since early 2020 going into earnings season. So the bar is set incredibly low, but it's sort of like nothing else matters as it relates to the path forward except tariffs, the trade war, and guidance. And so I think investors are going to be much more focused on how many guidance forecasts get pulled as opposed to the underlying results, which is frustrating, but that's where we are.
Amanda, one more question here. And, people frame out the analog looking back. I am in the camp, I've said this, folks, where other than what we see, I got to be careful here, Paul, help me. Get the surveillance cork out. What we see at the White House, to me, it's got a huge 1998 flavor to it. I could be wrong on that. Don't bet the bank on that. But Amanda, do you have an analog to the past here?
I would say no. Mic drop. No. I was saying to someone earlier today, it seems like we continue to throw the playbook and the textbook out over and over and over again. And we're just finding ourselves in unprecedented territory here. And so I don't think the history is very helpful in terms of a guide for what comes next.
Don't know if President Trump's listening on 99.1 FM Washington or if he's on Android Auto in the golf cart. The president says, quote, all caps, this a great time to buy.
Okay, there you go.
There it is.
Buy the dip. Amanda, what does fixed income do in a portfolio these days? Have you guys changed your allocation to fixed income? Do you hide out in some short-term treasuries? What have you done there?
Well, there's a few things that we're contemplating adjusting again at the margin. In some portfolios, we have high yield below investment grade credit exposure and some emerging market debt. It's dollar denominated, so there's a little bit of a hedge there, but we are watching that very carefully given just the action that's been happening the last couple of days. We may want to start pulling back on that, but the belly of the curve still looks pretty attractive, that 5 to 7 year range. And so not going really short, not going really long, again, with the volatility at both ends of the curve, the sweet spot still feels like the 5 to 7 year range. So we think there's some relative attractiveness there.
Is there any attractiveness to gold up $102 an ounce? We're almost back to 3,100. I mean, there's some huge elasticities out on the Bloomberg screen right now. Is gold a legitimate investment within a conservative PNC bank?
We tend not to be buyers of gold in and out of cycles. I don't know that it's really that much of an investment thesis kind of story. So particularly as you're quoting sort of the levels here, I'm not sure that there's that much further to run in terms of gold prices here. It's sort of top, hashtag top. And so from a thesis perspective, it's really much more of a store of value story. And we think there's a lot more interesting opportunities in the equity market, even though there's a lot of purple haze uncertainty right now.
There is. Thank you so much. Greatly appreciate it. Amanda Gagati with PNC Financial.
This is the Bloomberg Surveillance Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 7 to 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.